My name's John McDonough, and I am Senior Managing Director at National Brokerage Atlantic. And I put these videos together for clients and prospective clients to help them, understand the value add that's being brought to you from National Brokerage Atlantic and the potential benefit of premium finance if it makes sense for your structure. So here's where we begin. We've got a person born in 1974, $10 million policy that we're running an analysis on. And the analysis is going to be, how does it compare from term insurance, 10, 20, and 30-year payments, self-pay options of permanent policies, of index universal life, whole life, variable universal life, all self-pay, meaning you pay those premiums out of your own pocket, and then financed life insurance designs using index universal life, both from a death benefit only standpoint, as well as from a potential tax-free distribution perspective. So born August 2nd, 1974, we have a $10 million policy. Protective right now is the carrier that, from a convertible standpoint, has the best rates in the market. So if you wanted to do a 10-year term, you'd be paying $9,981 a year for 10 years. 20-year term, you'd be paying $17,800 a year for 20 years. 30-year term, you'd be paying $32,630 a year for 30 years. And it's worth noting, and I did a video on this in the YouTube channel that I have, you can click on this link right here, that less than 2% of all term insurance policies written since the beginning of term insurance policies have ever paid a death claim, meaning 98% of them have not paid a death claim. And the reason is because insurance companies know how to underwrite risk, and they know how to price these and manage these and underwrite them with basically the understanding that if you get a 10-year term, barring you something catastrophic or unforeseen, you're probably not going to die from illness or disease. And so most of these policies, 98% of them, end up expiring, the term is up, people stop paying the premiums. And so really, you're just paying money that you're probably not going to see a benefit from. Statistically speaking, you're not going to see a benefit from, which is why wealthy clients and those that have the means look at using indexed universal life, whole life, or variable life. They look at permanent types of policies. The challenge is to fund them properly. Permanent policies require a significant amount of premium dollars to go in. And so it could be not within the budget, not within the financial plan. It's something to take a look at. So for an index universal life, ran the marketplace. Symetra and Pac Life right now have really good products. There's other really good carriers out there, but for this age range, for what we're trying to accomplish, these look pretty good. $10 million policy. The suggested premium for 10 years is $146,000 a year. And this is an index universal life policy. Again, I have some videos on this in the YouTube channel, but they have a 0% floor for downside performance. They have upside potential depending on the interest crediting method in the carrier that we're using. It's considered to be a fixed product with upside potential. Variable universal life is probably the most economical, but it has zero guarantees to it unless you pick an index crediting method that acts like an indexed universal life, and it can start to get a little convoluted. But a $10 million policy, Pacific Life, the suggested premium is $150,000 a year, $149,200. And then there's whole life. That whole life has been around since the beginning of time. It is the oldest type of permanent policy that exists. New York Life and Mass Mutual would be the top two carriers here. But for a $10 million policy, to fund it properly would suggest a $536,000 a year annual premium. And again, that's a lot of money to put out of pocket if you're not in that frame of mind. So what are the alternatives? The alternatives are, you look at term, you look at a lower death benefit amount, you try to fund it with lower premiums and it doesn't work as well, it doesn't have the efficiencies that you're looking for. Or if you can qualify, you can consider financing those premiums. And I know you've had this discussion previously, but Pacific Life right now, a $10 million policy, if you were gonna pay $90,000 a year out of pocket for 10 years, would provide a death benefit at age 90 of $14 million. And it has an internal rate of return at age 90 of 8%. And compared to the previous examples that I gave of self-paid options of indexed, variable, or whole life, you're looking at a 4.7 to 5.5% IRR if you considered it life insurance as an asset class, similar to what a bond or equity, like how does it fit in? You look at IRR, your cash out of pocket versus the return on the investment. And again, in this example, death would have to occur for that return on investment to materialize. But again, as an asset class, when you finance those premiums, it's 8%. We also have an option where you can create tax-free distributions. And in this example, Symetra being the policy of choice, the same $90,000 a year out-of-pocket payment could potentially create a $423,000 tax-free distribution starting in year 16 for the rest of your life. Now, the caveat to financing the premiums is that the lender would require collateral. And the peak collateral, depending on which way you want to go, death benefit only or tax-free distributions, could potentially be $650,000 on the Pac Life side or $540,000 on the Symetra side. And again, let's dig into that a little bit deeper on a one-on-one meeting. But here's the Pacific Life scenario. For 50-year-old, the columns 3, 4, 5, 6, and 7 are straight from the life insurance carrier. That is the suggested premium for maximum efficient funding on a $10 million policy, the policy value itself, and we're suggesting a actuarial guideline 49 regulated 6.3% return static in this policy. And we both know, or we all know, it's not going to be a static return. It's going to fluctuate because that policy crediting is tied to an underlying index, and the interest is credited based on the performance of that underlying index. However, it does have a 0% floor. So when the index is negative, you won't experience any negative performance due to the stock market. However, it won't have earned any interest in that year. So it has a 0% floor, but that's also why the lenders are willing to loan money to this product, because it does have a 0% floor. So policy value, then you have the cash surrender value. The cash surrender value is the portion of the policy that the bank can liquidate inside of 30 days. It is the portion that they can take a lien on inside of 30 days. And then you have the death benefit. The death benefit in column 7 is the initial death benefit face amount. The initial death benefit that we started at 10 million plus the policy account value stacked on top, and it continues to grow. Then we have the lending information, columns 8, 9, 10, 11, 12, 13 is bank lending information. So if the suggested premium for the maximum efficient funding for this death benefit only design is $745,000 a year, that's exactly what we're going to borrow from a lender. And we have different lenders that exist out there right now. And the current rate that we can borrow is 5.8%. And depending on the lender that we choose, we can get a no personal guarantee, non-recourse loan, or a limited guarantee, limited recourse loan. And we can discuss the options of that. Then we have interest rates going down to 4.5%. And that's not to suggest that we think interest rates are going to stay static at 4.5% or that they're even going to get as low as 4.5%. But because we are limited on what we can show from a historical performance of the actual interest that the policy earns, we're capped at 6.3%. So it's only fair to create a cap or a static 4.5%. So we can illustrate in this example the difference between the cost of borrowing money from the bank and the growth and the crediting of the policy. That's considered to be arbitrage. And I did a video about 4 different arbitrages also in the YouTube channel that you can find. And so this is a spread of 1.8%. And that spread of 1.8% is quite powerful. When we do that, we want to make sure that the client pays something out of pocket, right? Because banks want 2 things. They want interest and they want collateral. And in this example, paying $90,000 a year out of pocket for 10 years is significantly less than what I was showing you the out of pocket is for the index universal life, the whole life, the variable life, right? So $90,000 a year, and we can discuss that amount. That can be changed, that can be altered, that can be adjusted. What banks want when they loan money is they want 2 things. They want interest and they want collateral. And so in the early years, I mentioned that there's a portion of the policy that the bank can take as collateral. That's called the cash surrender value. We know we're borrowing the premiums and we're paying a certain amount. So when we look at column 13, that's the end of the year loan balance. That end of the year loan balance, what the lender does is they subtract the portion in that year of what the cash surrender value is, minus what your out-of-pocket payment is, if any, in that year. And that creates a gap collateral amount. Now that gap collateral in column 14 is going to be cash, cash equivalents, marketable securities, could be letters of credit, something that the bank can use as a cash alternative or something that they can get their hands on inside of 30 days. If, in their world, the world fell apart, we can discuss that. So the peak here, or the initial year, starts at 432,000, gets all the way up to 650,000, so a $180,000 increase. And then it decreases. And in this example, for this person, for you, by the end of year 11, we are out of collateral and you have a policy that is fully insulated by the cash surrender value of the policy, which is greater than the outstanding loan balance. This is our death benefit only design. If I look forward to our potential tax-free distribution design, which may be of interest to you, everything's the same. In this example, we changed the carrier, $90,000 a year out of pocket. The peak collateral now is $530,000 or $540,000 a year. But you can see in column 4, year 16, we start to take tax-free distributions of $423,000 a year out for the rest of your life. So the difference when you start taking those tax-free distributions, and that is a substantial tax-free distribution, is that clearly it would reduce the death benefit that your beneficiaries would receive. So in this, at age 85, after taking $423,000 a year out for 20 years, you have $6.3 million of death benefit at age 85. But if I go back to the death benefit only design at age 85, you have $13.4 million of death benefit. So you just have to decide, what do you want? And when we work with you on a design, we're focusing on affordability, we're focusing on qualification, and we're focusing on understanding. Those are the 3 things that we need for you to have in order for us to move forward. It's the same thing, term insurance, 10-year term is $4,000 a year for her, $7,000 a year on a 20-year, $12,000 on a 30-year. If we're gonna do self-pay options, anywhere from $84,000 all the way up to $400,000 out of pocket. But what we're showing is $65,000 a year, both death benefit only and tax-free distributions. So for her, on a $10 million policy, $65,000 a year, peak collateral gets up to about $430,000. At age 85, it creates a death benefit of nearly $18.7 million, okay? Pretty good. If we want tax-free distributions, which I think is attractive depending on your situation, $65,000 a year for 10 years, that's $650,000 out of pocket. Max or projected peak collateral is about $390,000. But then at year 16, age 59 for her, creates $321,000 a year of tax-free distributions. $321,000 a year of tax-free distributions is probably the equivalent of nearly $500,000 a year on a pre-tax basis. And $321,000 a year income tax-free for the rest of her life. Even at age 85, it has a projected death benefit of nearly $9 million. So it's a very, very, very attractive design. So that's a his design, that's a her design, and then there's a together design, a 2-person design. And in this example, the 2-person design, we've got the same options. We do not have 2-person design term insurance policies, a second to die. That only exists in the permanent space, and they're called survivorship policies because it doesn't pay a death benefit until the survivor of the first person passing to pay out a death benefit. So both have to pass in order for the death benefit to be triggered. Doing the same $10 million design. In this example, we show you guys financing the premiums, but instead of paying, or in addition to paying what you're paying individually for your policies, this is a $25,000 a year out-of-pocket payment. Collateral peaks out to approximately $215,000, and the death benefit income tax-free to your beneficiaries, and if it's held in a trust outside of your estate, it will be free from estate taxes. So we call this really the trifecta. If we can put all 3 together, we can put an individual policy on you that creates, Derek, creates $423,000 a year of tax-free distribution. Put a policy on you, it creates $321,000 a year of tax-free distributions. So between the 2 of you, that's nearly $750,000 of tax-free distributions to supplement retirement income, to supplement your investments, to supplement everything else. And then the cherry on top is the survivorship policy for both. Hope this was helpful. Look forward to working with you. Please let us know any questions you have. Talk to you soon.